Hello, Warriors. Good turnaround Tuesday. Ryan, Sinatra, everyone else there.
Hi,
Mike,
Dale.
how you doing? Hi, Ryan. Simon, how's it going? So, Ryan, let's start with you. And pound is pretty strong. Are they unwinding the euro pound? Uh, Euro pound spread or whatever the pair, is that part of the reason for
Uh,
cable strength or general dollar weakness as euro's pushing up too?
yeah, it's been a little bit of a mixed bag for the pound. We've had some, I would say, half reasonable data or non-bad data from jobs this morning. That's helping the pound a little bit. But you're right, what you're saying just now. We're seeing a bit of dollar weakness just creeping in. Euro sterling isn't really doing anything much. Still in that sort of
Yeah.
knocking its head up towards the 88, 70, 80 area, and not doing too much on the downside.
Aussie bringing up the lagging. Any reason? Could it be that maybe we do get a little risk off from here at major resistance, or any idea? China.
Yeah, China's in the mix. We had a slate of data out overnight, which wasn't as bad as expected. GDP coming in.
Ryan, I want to ask you. I'm sorry, you were just in the middle of your thought process, but when you talk about China, and I'm sure you discussed this on the Flow Show, isn't it crazy though how strong the data was, considering China's been locked down for as long as they've been?
Well, that's where I was going with it. There's a lot in the market calling maybe the data's been massaged somewhat.
You mean like their COVID deaths? At first they reported 37, and revised to 60,000.
Yeah, exactly.
So if they're admitting 60,000, it's probably 600,000.
Yeah, exactly. Right. You got to take. There's a lot of points that they have been under the cosh with COVID and this wave picking up. So it's really hard to see the data coming out as it did overnight. So yeah, you take it for what it's worth. But on the flip side, they've also said whether this is a leak out through the usual China press sources that they're going to potentially be looking at interest rate cuts and RRR cuts in Q1. So that's done for $1, putting a bid in that pair. But for the Aussie, yeah, we keep coming back to it. But I think there's a lot of influence coming in here from the Bank of Japan. That such is the big risk event around it, and what's going to happen in the yen crosses. It's the majors are sitting and waiting because they're going to get pulled and pushed around from what happens in the yen. It's going to be a big old mess. But on its own, Aussie dollar's not doing an awful lot, keeping the gains above 69, which is the first step, 69, 69.20, which is the first step. And we'll see what tonight early morning brings.
Another great reason to subscribe to ForexAnalytix is Andre Cardoso. I call him the Picasso of technical analysis, and he nailed the gold top. So subscribers are on it.
Yeah, great stuff.
So I mean, there's so much good stuff from the crew. I don't call it the dream team just because I'm subjective. The talent is immense, the technical talent of the team. Okay, let me get K-Man in, except I saw he may not be here today.
Hi, everybody.
Oh, you made it despite it. That's what a pro does. He pushes through any complications to show up. So your comment on yen here?
Yeah, right here. I think so. We've seen a bit of lightening up the positions, but the bond market is really pushing very hard against the upper side of the yield curve control. So as I was saying on the Flow Show, basically anything's possible with the Bank of Japan now, but I'm going to just tell you what my base case is. My base case is that for today, if they do any tweaks, it will be relatively light compared to the wildest expectations of some market participants who say they could abandon YCC. I don't think that they will, personally, because that would send kind of a chaos into the markets. Global markets, even if Bank of Japan just abandons something, being like the third biggest central bank on earth still, by masses of volume. So I think if we get a tweak, it will be a light one, perhaps just slightly widen the YCC again. But they should be telling us as well a little bit about what they understand that the side effects of their monetary policy is, because that's what that famous Yomiuri newspaper was saying, that they would discuss the side effects. So I'm really waiting to see what they are going to do. And again, I think anything is possible, as well as moves. If in the wildest moves, that would be completely abandoning YCC, dollar yen could crash to 120. And then possibly rebound to 130 when the market is feeling happy to take profits. But and if
So
they don't do
today-
anything at all, we're
Yeah.
probably trading around 131, 132, and then likely the market will start to push again, and then probably see a top of, around there somewhere.
All right. So on days like this, in the midst of central bank policy, probably can't count on the correlation between 10-year yields and what's going to happen to the yen right now. Correct?
Well, in theory, we could, because if you say that, okay, let's take the extreme. If they would abandon YCC, Japanese yields will start to fly. So we could see some form of rebalancing between US and Japanese bonds, for instance, which would be, in theory, pushing the US yields a bit higher if the Japanese start to sell US treasuries, right? And to repatriate the home. But again, it's a very wild bet right here and now to say what exactly is going to happen overnight.
Yeah, we have a short-term break of trend. As you can see, I just drew the line, the obvious line.
Yes, I think that's been helped yesterday as well by the better consumer data on the, what was it yesterday that came out? The I forgot already. Was it yesterday or Friday? No, Friday rather, right? The Michigan
consumer sentiment.
Yeah, that was the Michigan. I think that has to do perhaps a little bit with it. Yeah, but we are in the range, right?
Yeah.
I think the big message of your picture there is that we held 340 again.
Yeah. Let's see. Okay, Stel. Hi, Stel. How are you?
Hello, everybody. How are you?
All right. So it was a good idea to, just sit on your hands for silver.
We're still ranging, and like I said yesterday, we have our levels, or at least I have my levels, and I'm.
You don't own those levels.
Sorry?
You don't own them. Everyone has.
I don't know. No, I don't. But I try to sit on my hands. I still remember one of the first things that the guy who basically told me how to trade. One thing he said to me was the toughest part is to sit on your hands, and I didn't realize at the time how important that was. And you have to be patient when patience is needed. Otherwise, you're overtrading, and when you're overtrading, you lose almost always. So I'm still waiting. Now, you guys are talking about the JGBs and the Bank of Japan and all that, and they want to assess the effects of their economic policy, their monetary policy. And I was reading that actually Steve put a really nice clip where the Bank of Japan apparently own more than 100% of some of their benchmark 10-year JGBs. So they not only bought all of them, but they've lent them out. Margin. Yeah, so it's this kind of monetary policy, the Japanese are far ahead of everybody else. They've been buying, monetizing their debt for many years, and the amounts they're doing is staggering. So, with the central bank this deep intervening in markets. I mean, when they stop or if they alter what they're doing, it's going to have ripple effects, huge ripple effects. So I think that's why Cayman correctly said that they're not going to, I don't think they're going to do anything silly, and abandon yield curve control or do anything like that. They're going to be probably doing subtle moves here and there, slowly trying to change policy. But as I said before, when you're this deep, how do you change policy, without creating big effects on the markets? But anyway, sorry?
Very slowly.
Very slowly, exactly. It's
because don't forget that the Japanese government has been putting in place stimulus package after stimulus package the last 2 or 3 years again. So letting everything go would put the government in jeopardy for their borrowings.
Yeah,
and it's impossible to do, right?
Regarding risk, to me, it looks like we're at a pretty important inflection point. Bring Blake in here and
lots of resistance confluence. Yeah.
Yeah, I mean, are we going to break out? Last time, this was a big false breakout, but knocking on the door again. What do you think, Blake?
It's big time resistance. And good morning, team. How's everybody doing?
How are you doing, bro?
Do you know what the biggest risk for bulls is? Did you read Jim Cramer said, I see bullish signs for the market? So
yeah. I mean, he's like dangerous. It is dangerous. He's the new Gartman.
They actually have an ETF, which is they take the reverse position of his recommendations.
Yeah, I know. Could you think about like the millions that would have been made against Dennis Gartman doing the exact same thing, and somebody's like, we need to do it against Cramer. So. And like I said, good morning, guys. I'm as far as the S&P goes, I think we are at key resistance. I don't think there's anything that suggests otherwise, but I don't know, like, if I would be, well, I'm already selling risk. I mean, I'm selling risk because I'm long dollars here. And, that's just plain and simple. But
what's your preferred short? I know you were talking about MEX yesterday. You were looking for a turn. Did you get it?
I'm long dollar MEX. I am long, actually, right at current levels. But I'll talk. I can talk about that here in a second. But I just want to say that I think the S&P is, a lot of people are leaning into it and leaning on the long side, and really think that the Fed is going to be a little bit easier than I think the market is willing to come to grips with. Thinking back just to last week and thinking that CPI data and watching the market reaction following the CPI and just seeing that we're still where we're at with an inline CPI print. And I know that, everybody probably expects that CPI is going to come off and continue to come off this year, but we're still so far above the Fed's 2% inflation target that I just don't think they're going to be as easy as the market believes. And so when you're looking at like the move of the S&P, technically, we are at the 618. If you can see that last false breakout way up there. Now, just remember that whether you like it or not, this area here in the market, this is a false breakout. Like right here, that is a false breakout. And that's still going to weigh heavily on the markets, in my opinion. So, we still have to contend with that. And so I look at like this bounce that you've seen here in the markets to where we're at currently at the 618, which is where we're currently at. I look at it as more of a gift. Because like I said, from a risk reward perspective, it's set up for a short. Now, does that mean that we're going to break down? I mean, I'd like to be an optimist here, but looking at some of the extremes around, I'm scared to be thinking that. Now, volatility came in at a really big extreme at the end of last week. I'd like to see how volatility performs today. It's bid up this morning. We have Microsoft that's down pre-market. There's some downgrades that hit Microsoft. Oops, I'm sorry. I don't know why I did that.
Yeah, all the generals are under pressure, Blake.
Yeah,
a few weeks ago was Apple. Now it's Microsoft.
Yeah, and those are big. They're big companies. It's not like dollar store or something. This is, Microsoft. It's a big name, and it really hasn't performed all that well. And so we start cracking through some of these supports now. I'm not saying that's going to happen today, but you look at Microsoft longer term. I mean, this is not a bullish sign for the markets overall. So I would just be a little careful here with some of these stocks now. So that's a long way of me saying, Dale, that I think that the S&P is at a pretty big inflection point, but I think it sets up great for shorts near term. I mean, risk reward is set up there, and it might not be like right at this very second. It may not be the best short. You might just want to wait for like a breach of some of these support levels here intraday. But we start cracking through some of those levels, and I think it offers up a good opportunity to be on the short side. So anyway,
so thank you for your imitation of Steve on that answer.
Yeah, so he's not here today, so I'm taking over in Steve's regard. I'm still trying to, I hear you fighting it. I'm still fighting the good fight over here. I'm hoping by the end of the week I'm going to be completely done with this sore throat and phlegm and all this blah 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 stuff that I'm dealing with. I was just looking back, and I was talking to one of the traders in our chat room, Chris. He's like, I get a sore throat every 2 years or twice a year, and he's in Japan, and I'm like, I don't think I've had a sore throat in like 7 or 8 years. It's been a long time. So I don't know, Dale. It's not something I contend with. Fortunately, I know you don't either, and we talk a lot.
Yeah.
So my wife will tell you I talk quite a bit. So anyway, so I think the S&P sets up for a decent short up here, like I said, and my preferred trade, because you asked me earlier, is going to be the dollar max. And I am long. We had 127% extension. I'm in other dollar trades, and if you're in the ForexAnalytix chat room, which here's the chat room, you can see like some of the charts that we update this morning. Here's like the trades room, so you can see like positions that I've taken and what I'm doing, and not just myself. You got K-Man, you got Brand, you got Craig, you got Nitish, you got just traders all over the place. We're in the ForexAnalytix chat room, and that's where we talk about what we're actually doing. But the dollar Mexican peso, I think the sentiment is really extreme, and it is a risk whipping back. Now, overall, I am very bearish the dollar Mexican peso, and I've been that way literally for a year, maybe even a little bit longer. I mean, K-Man, I'll ask you, because you my as Dale would say, my warrior trading peso brother in the chat room. I think we trade the peso probably predominantly more than anybody else. It's bearish, but what do you think about being short down here?
I wouldn't initiate short positions here. What I'm still doing is trying to find rallies to get a bit long Mexican peso versus one or the other, whether it's dollar or sometimes the euro. I still think the Mexican peso, due to its current fundamentals and high yields and being the US manufacturer now, it's the longer term trade is still there. But as usual, when things seem too obvious, they could be a bit too obvious at times. So I'd rather wait for a return up to 19s or so to try it again.
Yeah, that's what I look like. It's like just give me a little bit of a squeeze back towards like the 1920s or something, like somewhere up here.
Yeah.
And I'll play into that descending channel. And I'm with you. I think the fundamentals line up great to be long Mexican pesos. Trading wise, I feel a little bit differently, obviously, over the last couple of days. So anyway, that's where I stand with that. Now I know there's people that are starting to tune in that might have missed the conversations we had 10 minutes ago. But let's rehash a little bit with the dollar yen and the BOJ. So the dollar yen, we're coming into some pretty key support. And on Sunday, I actually closed my dollar yen short. I was short dollar yen over the weekend, and I would, riding it on the short side last week. I closed it out around 127.82, I think. Well, shoot, I'll tell you exactly where I closed it out. You can just go over to the trades room And then you can go from here, you can scroll up and see whatever I was doing on Sunday night. I closed it out at 127.69. So that's where I got out down here. And I don't want to be short anymore, not ahead of the BOJ, not knowing what we know now. I think, we could be at risk of a squeeze higher. But, you look at all the other yen pairs. I just want to quickly, look at like the euro yen. We're not making lower lows, which is good. The guppy, we're trying not to make new lows here either. The Aussie yen, I would argue that we're probably in an ascending channel here, something that looks something like this, right? Something like that. You got the Kiwi yen, obviously is forming some pretty critical support. And you got the Canadian yen that also, well, I guess that is making lower, slightly lower lows. But when you look at all these yen pairs, I think pressing yen long, the dollar yen that'd be to the short side, is getting a little bit more difficult at this point.
I heard it's very crowded as far as positioning. The long side, the yen, has become as crowded as it's been for I think a year or so. Well,
I would, and I'd love to hear what Ryan and Cayman and Stelios have to say about this, because we were shorting dollar yen when it wasn't cool to short dollar yen, which was up in the 140s, last year. And here we are, going into January, and we all talked about this at the end of 2022. Our favorite trade is really being long yen this year because of the shifts that the BOJ is probably going to make. But we're pretty early into the year, and Kuroda is still at the helm of the BOJ. So I don't think being short dollar yen here makes a whole lot of sense, or being long yen here. I'm hoping for a bounce and maybe even back towards the 200-day moving averages, and I'm more than happy to trade that on the short side. And I have no yen exposure, but what do you guys think? I mean, let's start with you, Ryan. What are your thoughts here?
No change to my thoughts. I've been bearish since latter part of last year, as you know, dollar yen in particular. It went far faster and harder than even I thought it would to the downside. It's a binary event now, and there's big price risk both sides. So if you're not in a yen position, you don't want to be guessing right now, because you can find yourself 300-400 pips off either side, depending on what happens. But I think you're right. I think you need to take both sides of the coin. If they sit on their hands, do nothing, continue with policy, no changes, we are going to get a rally in yen pairs. Then you're going to look for your top side levels. We've got some in the 129s, so that's a bit too close. You're looking at potentially 130s, 131s, 133s, and the higher up at 134.5. Downside, we've got this big level into the low 127s. We've got the 50 fib of the move from the 102s there at 127.30 or something around there.
I think it was actually low from last week was at that 50% retracement.
Bang on it.
Bang on
so
it.
That,
correct.
That's your first downside target. But you have got to rethink that if there is big news, we could be 135 or 120. It's that much of a risk. But what I would say to people, if you're not trading the yen, if you're trading other pairs, the majors, the dollar majors, that sort of thing, you've got to watch what goes on here, because the yen pairs are going to move the majors. And as I was saying on the flow show, if you get, say, for example, I use the same example, let's say euro yen, falls out of bed, and that drags euro dollar down to 106, 105. You've got to look at that and think, well, that's pushed it out of sync with what euro dollar's doing in the main. Is that the type of move that you want to fade in euro dollar? Because as I say, it's not going with the fundamentals. This has all been driven by another pair and something else. So those are the sort of moves you want to look at, is if it's pushing things out of kilter. But also, I'll repeat again, and this is probably the trade I'm really looking at, is if the Bank of Japan do nothing, we get a rally in dollar yen. I'm potentially going to be looking to add to my short position, and then watch the CPI on Friday, because if they do nothing, say they're going to continue easing, and we get a big CPI report on Friday, it's coming all the way back down. Any rally we get in dollar yen, the market's going to go, there we go again. They're going to have to tighten, and it all comes down again.
You know, guys, stick around for.
We have CPI. Who's got CPI?
Japan.
Oh, Japan's got CPI. Okay, all right. I'm just looking here. Japan's got
Canadian CPI as well in a few minutes.
Oh,
yeah.
Okay.
Japan CPI is on Friday. So I'm saying you've got a bit of a gap between the Bank of Japan and then the next big piece of data.
Isn't it interesting that we are paying attention to Japanese data? I mean, it's great, and I love it from a volatility standpoint. In the FX market, we haven't cared about Japanese data since I've traded currencies. Really, I mean, I've been trading since 2001. I started trading currencies, and I switched from trading equities predominantly, and I never cared about Japanese data. But now that they might be moving, monetary policy a little bit, look, we got to start paying attention to it.
And that's the benefit of following us here at ForexAnalytix, because we've been watching this for weeks and months, waiting for watching the turn. Are they finally going to get some strong inflation? And we've been seeing that for the last few months, and it's led us up to this point.
And you guys have had it so freaking easy in Europe. You guys get to sleep, not worry about economic data moving the markets. And us here in the United States, I got like alarms going off at 1 a.m. because some European German ZEW number is way better than expected. And you know what? So screw you guys in Europe. You guys get to stay up all night long now. That's it. That's it.
I think it's going to be a long shift tonight.
Well, yeah. So, jokes aside, though, you make a great point, Stelios. We have Canadian CPI data coming out. Here's the thing about the CAD. I look at it longer term, and I see this Gartley pattern. I'm A, B, C, D, playing out. I think, but then again, I'm not very bearish the dollar here. So I'm gonna say that a move in the dollar CAD above this 135 level is probably going to goose the market a little bit. So that's something I think we should be paying attention to. Do you guys have any views on CPI in Canada? Because it is coming out in just a few minutes. Plus, we got Empire State Manufacturing
I like that
data.
chart.
Yeah, and then
EKG. That's my EKG.
Pretty, right? Let's Ryan, K-Man, Stel, did you guys talk about it on the Flow show earlier today? Did you talk
I wasn't there, I'm afraid, so I don't know what to talk about. But I have to say, we're expecting a year-on-year CPI to come down from 6.8 to 6.4. So this is in line with kind of CPI dropping worldwide. Again, if you ask me, I think the risk is for a print slightly below. Yeah, I don't know what Cayman and Ryan said on the Flow show, because I wasn't there. Sorry. But
why did you bail on them?
I had stuff to take care of at home.
What kind of stuff?
I got stuff, Dale. Dale, we got stuff.
Blake has a stuffed nose.
I got stuffed nose. I got stuff in my underwear. I got stuff. So, Ryan, Cayman, any thoughts here?
No.
Okay, thank you. Much appreciated.
The market just wants to see lower data. So get it
right.
By the way, we also have an Empire State Manufacturing.
Be careful on the Bank of Canada core CPI, because that's expected actually to come in a little higher than the other one. So keep an eye on that one. But the market wants to see downshifts, and so the surprise trade would be a higher one.
Okay, that sounds good. Thanks, K-Man. Good points. By the way, while we're waiting for this data, we got 30 seconds. Have you seen the prices of eggs here in the US? I don't know. It's gone absolutely bazonkers. And
do you have no chickens there?
No. Apparently,
there's a bird flu.
People are calling it. No, that's what people say. That's what the mainstream media says. But really, it's I've also heard, and I'm listening to a few podcasts about, like, productivity is, because of the just inflationary pressures, they've had to shut down a lot of farms, and it's like,
Empire State very bad. And look, CPI year on year 6.3.
Wow,
and
look at that
core
CPI down
5.4. So core is lower.
Wow.
And Empire State very, very negative. Look at that.
Minus 32.9.
Did it move anything?
It didn't really. I mean, the dollar CAD, you'd think it would spike higher on that news. And it's just kind of moved.
Bad data on both fronts. That's a problem.
Yeah. And I mean, stocks just spiked higher because, remember, stocks like bad news. Bad news is good news for stocks. So the S&P spiked higher, but I don't know. At what point does bad news and poor data translate to, holy shit, we're dealing with a recession right now,
when earnings are revised down.
Yeah. Oh my God. Hey, wait, life isn't good. I don't know when the market makes that switch, but right now that print is not good.
It's a bit like Germany and the euro. They want the euro to be weak, but they don't want it to collapse. So that's what the market wants, so kind of weaker data, but no major recession.
It's the porridge. It's the porridge. I don't want it too hot. I don't want it too cold. I want it just right. It's the porridge.
Exactly.
All right. And, with that being said, I want to thank everybody for being with us today. Make sure you guys check out the Trader Funding Program. I was actually just having a conversation with Nick, a guy that has traded and, taken some pretty big payouts, and he's going to be putting together a video. We're trying to nail down, he's in Europe, so we're trying to nail down a time to interview him. Just look, if you want to trade our money and not risk your own money and make 75% of the profits, and let's say you just don't have access to $1 million account or a $250,000 account or a $25,000 account, well, come check out what the Trader Funding Program could do for you. And remember, with that, you get included into the ForexAnalytix community for a period of time. So this way you're not trading on your own. You're in a community. You can, talk to other traders. You can see what I'm trading. You can see what other traders are trading. And so it just gives you more ideas, and, having ideas in a volatile environment is a good thing. So anyway, I want to thank everybody for being here. I know, Dale, you have a great interview with Jamie from Reuters, right?
Yeah. And we're going to be covering the BOJ and the end. So if you,
I can't wait to hear. Jamie, you guys stick around. Jamie's probably one. There's a few reporters on the street that I really, really, truly appreciate their work. One of them is Jamie. So you guys are in for a great interview. So Dale, thank you so much. Team, thank you all. And we'll see the ForexAnalytix crew on the Morning Edge, which is the private show for ForexAnalytix subscribers, in about 45 minutes. Thanks.
Thank you, Dream Team. And welcome back, Jamie. Happy New Year, buddy.
Hello, Happy New Year. Can you hear me? Can you see me?
I can hear you. Are you trying to show your camera? You going video?
How do I do that?
Lower left.
Start video.
Lower. Yeah. Okay.
There you go.
All right. So we have some ground to cover, Jamie, and
we do, and you seem to have covered quite a bit of it in that last fascinating conversation, especially on the BOJ and what's going on in Japan. But
where do you want to start? You want to start with that?
Well, we can do, but just as you were introducing me there, I was looking at the Empire State, the New York Fed manufacturing numbers that just came out, and whoa, that's a bit of a shocker, isn't it? I mean, we're talking about good news is bad news and bad news good news, but I mean that seems to be bad news.
Yeah, S&P's. The question is, when is the market going to take bad news as bad news, Jamie? Where it will be risk off instead of risk on, because yields will come down on bad news. And
in many ways that's a $64,000 question, isn't it? I mean, I think it's fairly obvious to say that when the bad news comes in, the bad economic data comes in, it stokes expectations that the Fed will pivot or go easy, or however you want to characterize it. And of course, the sort of maybe the taking some of the froth off the interest rate expectations will put a floor under the equity market and risk assets. But because this is, of course, as you know, it's probably the most flagged recession in history. So, I mean, as one of your previous guests said in the previous segment, this has been basically since March, April last year, we've been talking about recession in the States. So if anybody thinks that recession is, has suddenly come upon them without any warning, they haven't been paying attention. So in many ways, these kind of numbers are kind of, if you like, to a certain extent, baked in the cake. And you just look at the Bank of America Fund Manager survey that came out today. I think also you were talking about it. One of the most interesting bits of information from that was that investors are, I think I'm right in saying, the most underweight or underexposed to US equities since 2005.
Okay.
So
they're going
not
elsewhere.
Only do you,
they're going to China,
exactly,
emerging
and
markets.
to Europe.
Yeah. Okay.
And so you have a positioning thing here as well. Whereas if this bad news comes in, again, it obviously has an impact and influence on Fed expectations. And given the underweight, the large underweight in the market, it's maybe no surprise to see stocks tick up on this kind of stuff. But as you said, or as was said earlier, I mean, once earnings expectations and forecasts start to come down, then surely bad news must start to mean bad news.
Well, don't you believe there's kind of a battle going on that the market doesn't believe Fed rhetoric anymore? And is the market wrong for doing that, Jamie?
Don't fight the Fed.
Are they calling,
don't fight the Fed. No.
Well, they're calling Paul. They're calling his bluff that he's almost done. And is there going to be a rude awakening at the end of the month?
Well, much like the recession has been, baked in the cake or priced into forecasts for several months now, so is this idea that the Fed is going to pivot in some way. Now, depends what you mean by pivot. Does that mean switch from rate hikes to outright cuts, or does it just mean slowing the pace from 75 down to 50 and then 25, or does it mean a long sort of hiatus or a pause? You can pay your money, take your choice on that. But one of the interesting charts that I have up on my screen is...
You want to show it?
That's beyond my pay grade.
All right, buddy. Okay.
My technical ability.
I'll show you. I'll show you
next time. Basically, it's a chart of March, June, September, and December 2023 SOFR contracts and implied rate. So basically a chart of what the market has been implying for 2023 Fed policy. And you put them all together, and since mid-May, I think it was May the 11th or 12th last year, the market has been consistently pricing every single day since then some degree of Fed easing. Now, that doesn't matter whether the terminal rate back then was as low as 3.25%, or now, as we all know, the terminal rate forecast is 5, just over 5%. No matter where the terminal rate is, since mid-May last year, the SOFR rates futures markets has been consistently pricing in some degree of Fed easing.
How do you spell that, Jamie? How do you spell that? The SOFR?
SOFR, S-O-F-R, the securitized overnight funding rate. Basically, a sort of it's a rates future like Fed funds.
Okay.
And Fed funds, I mean, they have different characteristics, but Fed funds have basically shown the same kind of pattern, although the extent to which the spread between various contracts varies. But since mid-May, as I keep saying, some degree of easing for this year has been priced in to the Fed's implied rates contracts. And that's ranged from 10, 15 bips to as high as 60, 65 bips. We're now about 50 bips of easing priced in to the curve for this year. And that seems to fly in the face of everything Powell said, everything all the Fed officials have said. Some of them have been quite blunt in their language and said, we are going to put rates up around 5% and we're not going to cut. We're not going to cut this year.
And it's going to stay up there for a while.
Exactly. Now, to caveat that again, you go back to this time, or maybe 12, 13 months ago, when they were saying, when the curves and Fed officials were basically guiding that there'd be no rate hikes at all in 2022. And of course, what happened? Well, events, dear boy, events. And they quickly had to change tack. Now, the markets seem to be believing and betting on some degree of Fed put. They're quite insistent that they won't, ease, but the market doesn't believe it. And of course, you think that the Fed's going to ease from 5% down to 4.5%. That's still 4.5% Fed funds rates, which is way higher than we were banking on 6 months ago. So it's all relative as well. Even 50 bips of easing is still a pretty high Fed funds rate of 4.5%.
Okay. Do you think the Fed is unhappy about monetary conditions, easing, weak dollar being part of it, and and the wealth effect with the stock market rebound?
They can't be happy with that, surely. I mean, Chair Powell has referenced financial conditions a few times in speeches in recent weeks and months. But the one that I look at the Goldman Sachs Financial Conditions Index. That's updated real time, and it takes into account equity prices, the dollar, short rates, long rates, and credit spreads. And I don't have it in front of me, but financial conditions have eased since, I think, when did the Fed start to go? I think it was September, October time. Financial conditions have eased since then. I think I'm right in saying.
Since that article they put out on a Friday afternoon that was interpreted as a pivot, and that was near the USD Japanese yen high in the 150s.
That seems to coalesce. Yeah, that could fit. Yeah. I think it was around about that sort of time. But yeah, they surely cannot be happy with the easing of financial conditions if we assume that the whole the whole point of their monetary policy right now, their stance is to tighten conditions. We're not really seeing it in the labour market that come through yet, but certainly in equities. I mean, stocks have come down in recent months, but they're back up again. And if the
on the verge of a breakout. In fact, a lot of people are saying, if you look at this long-term channel, Jamie, we failed to break out here, but this trend line goes all the way back to the high in January of last year. See that? So we're about to break trend. It could be turned back again here, but it's threatening a breakout.
And wasn't there, again, I don't have it in front of me, but the 200-day moving average in S&P, was that not a level that the market reached?
Yeah, here we are, 200, we're above it.
We're above it now, okay. So that was in the last few days, we've broken above it.
And here's the 50, we could end up with a golden cross if the advance continues.
Well,
what are they going to do? What are they going to do at the end of the month?
Well, I think I was looking at CME Fed Watch on Friday, and it was a 92% probability of a 25 bip hike.
Yeah.
So that's, for them to go from that implied probability pricing from the market, and they've indicated that many Fed officials have indicated that they will start to look at some of the cooling economic data and take that into account into February 1. I think the bar's quite high for them to go 50 again.
Okay.
Given where the market is now. Now, of course, it's only January 17. There's a bit of time between now and then, but they don't want to push back against market pricing and market expectations too abruptly, I would imagine. So let's assume we go for 25 next in a couple of weeks. What does that do to the S&P?
Yeah,
probably pushed it higher. However, on the other hand, and the economists have many hands, you get numbers like this New York Fed manufacturing data, the services, the ISM a couple of weeks ago or last week. That was a shocker as well. I mean, that was clearly in recessionary territory.
Okay, all right. So the battle goes on between what the Fed wants,
bad news, and
what the Fed wants to do and what the markets are doing. So, we're coming into what could be a pretty big inflection point at the end of the month.
And of course, the Fed's, the Fed has a dual mandate, of course, in its employment and price stability. I think it's safe to say the labour market. I mean, there are various ways of looking at it, but the labour market is holding up pretty well. Wage growth is, reasonably solid. Not super inflationary, and its real wage growth is still not quite in positive territory. But let's assume that the labour market is okay. The Fed can turned its head towards inflation. Inflation's clearly coming down. I mean, 6.5% is still way above target, but there's no question price pressures are starting to ease. And by many measures, if you take in base effects and some of the year-on-year price price moves in, say, oil, various commodities, aluminium, copper, wheat, some of them are, oil, for example, is now year-on-year negative. So the base effects are starting to come through there. And some of these other commodities that I mentioned, the year-on-year prices are substantially negative and have been for several weeks and months. So I think the trend in inflation quite clearly is to the downside, and you get these ISM numbers and there's New York Fed manufacturing data. Price pressures are easing. It depends how quickly and how fast these prices are starting to ease and how comfortable the Fed is with the general trajectory, and can they get back close to target within a reasonable period of time. That's where the Fed's attention will be, and I think more numbers like these very weak numbers that we're starting to see, ISM, PMIs, these activity numbers, Fed manufacturing, and the Fed could really take them into account, and it'll be 25 bips as opposed to 50s, and then a pause and make them into view.
All right. So as far as commodity prices easing, a lot of that happened during the China lockdown. All right. So we have a reopening. Look at the massive move we had in copper.
That's true. Yeah.
Okay. So I mean, there are crude oil acting okay. We've had big breaks in weather for natural gas prices to be low, although in California, because of I think pipelines and availability, we're paying triple for natural gas this season. So could the China reopening also be something that gets in the way of the Fed trying to cool things off?
It certainly could be, yeah. And I think as you were discussing earlier, these numbers from China today, I mean, many of them, the GDP, I think retail sales, investments, and what was the other one we had today? Industrial production for December. Yeah. There were many of them were at historically low levels, but relative to expectations, they were way better than expected. I mean, I think retail sales were expected to come, to crash 8.5%, 9%, and they only came down 1 or 1.5% or something. They were way better than expected. So that will factor into expectations, and if that is an indication of things to come in the coming months as China does reopen and gets over the hump and the rough patch of transitioning away from zero COVID to a reopening, then yes, the inflationary pressures are probably to the upside from China. So that's another that's another one that's a googly thrown by China there, and the Fed and other central banks, particularly in for example the ECB, they'll have to take that into account, because the Eurozone economy is kind of hitched to the Chinese economy in many ways, perhaps in some ways more than the US. So they have another problem on their hands.
Okay, why don't we go to talking about the BOJ today, since it is an important event. And I remember we were talking about, the first failed intervention by the BOJ here. And then we had this blow off move. And I believe this candle was made, the Fed leaked an article to the Wall Street Journal on a Friday, while the Japanese were still intervening up here. And that formed a top. The drop
was that in October? Yes, October.
Yeah, the drop's been phenomenal in both US dollar yen and the dollar. I mean, no corrections, pretty straight down. What do you think the BOJ is going to do? There's all kinds of expectations about them for today, yield control, etc. What's your take going into it?
That's a fascinating chart, that, isn't it? As you say, pretty much one-way traffic, and the speed and the extent impulsive. Of the move. Yes, very much so. And we as you said, we were talking about that first failed attempt at BOJ intervention. However, step back a little, and Captain Hindsight might say might have a different view. That first attempt, and it had, I think, 2 others subsequently. Yes. So late September and then again in October. Combined, the 3 interventions amounted to what, 65 billion dollars, I think it was. And you could argue they actually worked.
Yeah, they made a lot of money on the trade. They did what we teach traders not to do, add to losers. But average out, if it was a great short at 38, it was a better short at 44, and what a great short at 52.
51, 52, yeah. But, ultimately, they can argue plausibly that their intervention worked. I think they came in at 44, 45. It did pop up to 50, 51. But here we are, 27, 28. So we're sub 130. And you tie in that with the subsequent shifts in their yield curve control, which came just before Christmas. And it's a pretty powerful force, their FX intervention plus their yield curve control changes. And so it's no surprise to see dollar yen where it is.
And it's a fly in the ointment for people to say interventions never work, right? I mean, that is the mantra of most FX traders and houses, that you could fade intervention. So what do you think they're going to...
Fade intervention? Well, I think the history of G7 and certainly the Bank of Japan is pretty good. And certainly the big G7 or the coordinated events, 85, 87, and then again in the early throes of the euro. And now here, the BOJ, and of course the Bank of Japan normally sells yen. And this was the first yen buying intervention since 1998. I think the track record of these guys, again, very big picture, is pretty good. And you have to have pretty deep pockets to take them on. Maybe that argument is for another day. But what's the Bank of Japan going to do today? Well, if it weren't for December 21st, whenever it was that they sort of stunned us all, you would have to think they're probably not going to do anything, because Kuroda's term is up in only a couple of months, 2 or 3 months, and so they'll just stand pat and maybe offer some guidance towards a shift in April. But I think the events of last month have to have us all on our toes, and I wouldn't be surprised at anything. There's an interesting everything. Expect anything and everything. I mean, given what happened, given the sort of waves they made in December, they may sort of think it's opportune to just maybe take a step back and maybe Kuroda in this press conference can give more guidance rather than outright changes to policy. But there was an interesting note from Citi. They had 6 potential options, or 6 potential scenarios and possible dollar yen outcomes, varying from standing pat, no move at all, towards outright terminating YCC completely and giving us all another heart attack. And they attach various probabilities to that. And quite interesting, they say they attach up basically a 1 in 3 probability of completely terminating yield curve control. Now, I don't think the market's probably positioned for that. I think that would be quite extreme, again, especially given that we're only a couple of months away from Kuroda's, sailing off into the sunset. Would he want to have that on his copybook as his legacy? That such a dramatic
abandoning his policy that he had all this time.
Exactly, and not only abandoning it, but basically in the space of what would be a month, less than a month. I'm not quite sure about that, so that's quite a high probability. But the guys at Citi did estimate if that were to happen, we could see a 5% fall in dollar yen. And I think I don't know what your FX guys think about that, but I think that's a fair estimate. In fact, if anything, it could probably over the days and weeks go down more than that.
Okay. All right. So why don't we wrap with what you're seeing in the Eurozone? And do you think that we're going to have a rebound there? They did catch a break with weather this year.
The weather one is fantastic because, I've been covering these markets and macro stuff for nearly 25 years now. And whenever I see or hear, whenever I see a research note saying, we got our retail sales expectations wildly wrong, it was down to the weather,
Okay, yeah.
Everybody has always
blame the weatherman.
Blame the weather, and it seems to be a classic fallback for economists or strategists who got their calls wrong. And I think for the first time ever in 25 years, I think they have a case now, because the weather in Europe has been much warmer than expected. The winter nowhere is bad. So all these, doom and gloom calls for recession in the Eurozone and outages and shortages and rationing and all the rest of it to do with, gas and energy, that hasn't come to pass. And so storage levels of natural gas are way higher than expected, so much so that they may, for next winter, the continent may be in a
That's what they're worried about
position.
is next year.
Well, they got this year wrong, and again, they aren't Met men, so perhaps it's fair play to them. But the weather has been crazy, and just one stat that caught my eye: average temperatures in Germany since the end of September. So basically, the last 3.5 months, the average temperature in Germany have been 25% higher, or than average. Sorry, the temperatures since September have been 25% higher than average. Now, I don't think anybody would have seen that coming. So that's had a huge effect on the energy side of things. And Goldman Sachs is the one that springs to mind, but they've completely removed their Eurozone recession call. I think almost every other investment bank on the street is revising their Eurozone call, if not taking away recession, then certainly modifying it hugely. And so that's why we're seeing the euro up, 10% in the last few weeks. We're much closer to 110 than sub parity. And guys at Morgan Stanley just noted that again in the last 3 months, the last 90 days, Eurozone stocks versus Wall Street. Eurozone stocks are on their best run, the best relative performance to Wall Street in 20 years.
That's a big deal.
It's a big deal. And again, of course, that's all in the past. That's in the rear view mirror. Do you want to maybe take the other side of that now? Again, especially given the what we were talking about earlier, investors are underweight stocks, US stocks, so their most aggressive underweight position in 20 years. So the Eurozone story is a fascinating one. All those doom and gloom calls are being completely revised. When does that start to become in the price in either the euro or the Eurozone spreads or the Eurozone bond market? That once that starts to be priced in, then maybe you start taking the other side of it. But right now, Eurozone economic expectations, the expectations index is flying because expectations were so low. They're coming in much better than expected, and again, relative to the US. That gap between expectations is huge now. At what point does it start to close? We'll find out. But when you get numbers, again, going back to the New York Fed manufacturing, if they continue to come in weak on the US side, that Europe versus US spread and trade may be open for some time.
So the US is no longer the best dirty shirt in the neighborhood, is it? It might be the dirty shirt has a couple of rips in it.
Well, yeah, maybe all the stains aren't coming out in the wash quite so soon. But you just have to look at current performance. Wall Street's up about 4% this year. Eurozone stocks are up about 7 or 8% so far this year. So it's been a good start for Europe to the year. Long way to go.
I tell you what, Jamie, great insights again today. Every time I talk to you and bring you in here, we learn from you. And thanks for crystallizing some things. And we'll go with the narrative that most likely BOJ stands pat with the outside chance of, something wild happening, and that people should stop looking at the U.S. as being the leader of economic growth, the economic growth engine, when the rest of the world seems to be doing a little better now.
Well, as you guys were saying earlier, this is the first time really in about 20, 25 years that the Bank of Japan or the Japanese policy and data is probably the market mover, just because of and that just highlights and underlines the dramatic nature of the shift in policy in Japan. It's hard to quantify or get your head around the nature of that shift, because for decades they've been at the vanguard of easy policy, QE, negative interest rates, all that, ZIRP. Now they are going the other way, and it's a new seismic.
paradigm. It's
seismic.
A new paradigm, right?
Exactly. It's a new era.
It takes time to for most people to adjust to it. So, the new paradigm that we went through here in the US and now Japan and across the world. And I really appreciate you coming in here and crystallizing what could be pretty confusing for a lot of people. So more interesting FX markets and more interesting things to cover for you guys.
Never a dull moment.
All right, Jamie McGeever, everybody. Read his stuff on Reuters and follow him on Twitter at Reuters Jamie.
Thank you very much.
I appreciate it, Jamie. Talk to you in the spring, buddy.
Speak soon. All the best.
All right, Jamie McGeever, everyone. You could join the team in 15 minutes on the Morning Edge. Remember, good luck on the BOJ. Don't just count your pips, count your blessings. Great to have people like Jamie with the giving spirit come here and share his wisdom. Thanks again, buddy. Adios, everyone.
Bye-bye.
Bye-bye.